Welcome to the Scholar Advising Podcast. In this episode, we're diving into your questions about business structure, market strategy, and financial planning. We'll start with a listener question from someone launching a remote consulting business. Should you operate as a sole proprietorship or an LLC? We'll talk through trade-offs, especially when it comes to taxes and retirement planning. Next, we're looking at why the Federal Reserve hasn't lowered interest rates yet and what that means for us. We'll also consider a common portfolio question: how often should you review or rebalance a portfolio? Finally, in this week's Tool Spotlight, we'll share a net worth tracking app, popular request among our clients, that's built for clients with complex assets and privacy in mind. So let's get started.
I'm planning to start up a consulting side business. It will be entirely remote, meeting with clients by phone or Zoom, and will not employ anyone else. What business entity would you recommend? Sole proprietorship versus LLC. Primary concerns are taxation and retirement vehicles.
Great. So this is as the gig economy, so to speak, speeds up and we start to have more and more people in the entrepreneur space, 1099 income starts to become something that's big. Now, what that means is you also have the ease of opening up businesses that are not just 1099. And it seems like you're right on this path of the world has kind of opened up with Zoom and the comfort of people talking on Zoom, especially from a consulting side. We're in that space and have definitely makes things easier. And the quality of cameras nowadays makes it feel like you are in the same room with them. So that's great to start it off. But when you open up the business, you have to choose an entity. Now, what's interesting is if you just started offering consulting and were paid for it, then you're naturally a sole proprietor. And assuming there's no business licenses or anything that need to be filled out or completed for that business, you're there. You already did it, right? As soon as someone gives you $1, you're a sole proprietor. The difference in what happens there is that dollar flows through to you as personal income and is taxed as personal income. So there's no distinction in the government's mind between you, the business, and you, the person, right? They're both intermingled together. So if someone pays you money, it's yours, it gets added onto your tax return, and everything's fine. The issue with that is because the government doesn't see a distinction between you and your business, the problem really shows up from a liability perspective. Because let's say you have some consulting and maybe you give some bad consulting advice and you get sued, right? Or the business gets sued. They are now suing you, the business, and you personally because legally you're one and the same. There's no separation between the two. So typically in the old days of corporation structure and business entity structure, you'd go through and open up a corporation. And a corporation would allow you to have you, the person, as an owner of a corporation. And the corporation could sue, be sued, own property, and all this. It's still structured that way today, where you have limited liability of the owners. There's a hybrid version of this that was created called the limited liability company, which you're talking about. It's LLC. The LLC does exactly what it sounds like. It creates a separation between you, the owner, and you, the business. So now you have you as a member, not an owner of the business, the LLC. It's very easy to generate. Most states, you're talking about $100, $200 to have it filed with the state, fill out one form, and it creates a new entity for you. Go to the bank with your LLC paperwork. You can go open a bank account. You can go get a credit card. You can go buy property with the LLC. You can do whatever you want. The LLC is there. The benefit that it provides is it still creates an easy pass-through of income. So it's a pass-through entity. So any money that you make is just going to go through the LLC to you personally. So there's no double taxation. There's no corporate tax rate and a personal tax rate, which is the issue of corporations. You're still only taxed as one tax rate. So you get the benefits of the sole proprietorship on the taxation side, but you also get the benefits of the corporation on the limited liability side. So now there's a separation where if someone sues your consulting LLC, they're not suing you personally, right? There's a separation there between your personal assets and the business assets. So highly recommend going the LLC route. And some people will conflate that with something like an S Corp as well. So an S Corp is a taxation option. So you can have an LLC taxed as an S Corp. What that will do, and this may be stretching a little bit further, but this is probably going to be the next question as you structure the LLC, which is the issue with pass-through entities, especially with your concern about tax efficiency, is if, let's say, your consulting business makes $500,000 a year, because all that income is passed to you personally, you would pay employment tax on that full $500,000, which is not ideal. So what you can do is structure it as an S corp where the business pays you a salary, a fair and reasonable salary, and then anything above that then is taxed as gains or as an investment that's not income to you, that's going to be taxed as employment income. So you don't have to pay the Social Security tax or anything on that increased income beyond your salary cap. So that's probably going to be the next shift. And depending on how much money you're making in the consulting business, and if you already have things set up, that may or may not be an issue. If you're making $50,000 in it, it's going to be hard to justify, probably not worth the time to go and say, well, I paid myself a salary of 30, so I can have $20,000 of profit that's taxed less. So generally we start to see the S corp conversation show up after the $80,000 to $100,000 mark, is when you start to question, like, I'm doing this on the side, it's not a full-time job. So if that's the case, maybe I should be paying myself a salary that's lower and taking the profits off the top. The other huge advantage that you're going to have with the consulting business is the ability to open up some retirement vehicles as well. If it's only you or you and a spouse, you can open up a solo 401k or a SEP IRA for these. Both are extremely easy to set up. The SEP IRA is probably the easier one to set up. The only problem you run into there is if you do the SEP IRA, that IRA is going to count towards your pro rata rule on a backdoor Roth. So you don't want to do that. You want to go the solo 401k route. You'll be able to fund it at the same type of limits. And that's going to keep you at a zero IRA balance, which will enable the pro rata rule to be in your favor for backdoor Roth conversions. Those are the main considerations. We want to try to create as much liability protection as possible. You can also start thinking about some insurance, errors and omissions insurance or officer insurance there as well, depending on what consulting you're doing. Tax structure, right? We talked about the S corp, LLC, but I think that'll work, especially as the income level of the consulting business increases, and retirement would be right along with it, right? As the business grows, you're going to start having more options. Tax efficiency becomes more important, and so does the opportunities for retirement accounts as well. All right, and on to our next question.
The Fed hasn't lowered interest rates yet, even as inflation improves. Why are they holding off, and what should we investors take from that?
All right, so inflation has improved, and the Fed came out recently and said they're not lowering rates. And this has upset a lot of people. And people are upset with the fact of, like, why are rates so high? They should be decreasing rates. And you have to take a step back and look at what the Fed's role is. Right? The Fed has what's known as the dual mandate. So they have two jobs. One is stable employment. So they look at the unemployment rate, and the other is stable prices. So full employment, stable prices. So the only two metrics that they are their main drivers are unemployment rates and inflation, the value of the dollar. What ends up happening is the Fed has the lever to turn the party on and turn the party off, which is interest rates, right? If they want to really stimulate the economy, all they have to do is drop interest rates, and that makes money really cheap. So it makes it really inexpensive to go buy a car, to go buy a house, to go borrow money to invest in businesses and properties and all of these things, which we've seen the product of, right? This is what happened in the housing crisis in 2007, 2008. Low interest rates for too long made it really easy for people to go get free and available money. We saw the same thing happen again and during the COVID times, right? Low interest rates really throwing fuel on the fire with stimulus checks and everything else made it where money was cheap and free money was coming in the mail. So what happens when you have a whole economy that has really cheap money? They go to the bank and borrow stuff at 0%, 2% on a mortgage, and free money's coming toward me. I'm going to go spend some money, right? And that's exactly what happens. The issue with that is I go to the car dealership to go spend some money, and everyone else is there trying to spend money. So what does the car dealer do? They say, I have 10 people out front all trying to buy the same Honda Civic. So I'm just going to increase the price of the Honda Civic, or we'll call it a additional dealer markups. So we're going to put every car value you see out there plus 10 grand. And that's the price of it. And they could, because everyone had money and it was cheap. So what does that do is whenever you're trying to measure economic activity, and they say, well, what's the average price of a car this year? And they say, well, the average price of a car jumped by $10,000 for what they're paying. That's inflation, right? That now increased because people are willing to pay a higher price. And that's led by the Fed having low interest rates. Now, when the economy gets too hot and everyone's out there spending, you run into this inflation issue where people are willing to pay higher for goods, and that's increasing the price of all these things. So then how do you make it stop, right? How do you shut down the inflation? You make things more expensive. You make people have to go to the car dealership and negotiate for a lower price. So they increase the interest rates. And that's what we saw in 2022. We saw interest rates go from 2%, or essentially 0% on the T-bill up to 5%, the fastest increase ever in interest rate, period. Right? Not since the 70s, not since the 30s, there's period fastest increase you've seen in interest rates. So with that, now inflation, everything slams on the brake. Economic activity slows down, right? And comes back to normal. People aren't going and paying crazy prices for things, and everything calms down, right? That's where we're at now, right? Inflation has come down. The target for inflation for the Fed is around 2%. So we're hanging around 2.5% right now. So it's come down, right? That has succeeded by them increasing rates. The reason they haven't decreased rates yet is going back to when do you decrease rates? When you want to stimulate the economy, when you're trying to get people out there buying. But we're at our target. We're at the spot we need to be in. The economy is healthy. Employment rates look good. Right? Inflation has come down. Right? There's some uncertainty that the Fed has mentioned about tariffs and how that'll play out in the next few months. And that's the one thing they're looking at. So you have to look at it from the Fed perspective. Their job is stable prices and employment. We have relatively stable prices. If anything, they're at a little bit on the high end, right? They're a little over their target, which would be decreasing rates would have the opposite effect, and it would cause higher inflation. So they don't want to do that. And employment looks good. The economic data looks good, right? We're at all-time highs in the market, right? We're having like all these good things go on. That is not the time where the Fed needs to put fuel on the fire and create an economy that's booming even further than it is, because that's when you run the risk of inflation. The other problem with that is if they were to do, let's say that they said, that's fine. We want to add gasoline to the fire. The economy's looking good. Let's stimulate it even further. Right? And they were to lower interest rates down to 2%, 1%. Then what happens when the economy rolls into a recession, right? Or we have another business cycle? Then the Fed has no tools anymore to use to help stimulate the economy. They already did it, right? They already stimulated the economy. So their rates are already lower. So now the only option they have is to increase rates, and they'd be increasing rates in the middle of a recession, which is the opposite. So it's not that the evil Fed is out there trying to destroy everybody's life with interest rates. It's that they're following their job. Their job is working, right? We're at stable prices. We have good economic activity. Right? And if they were to decrease prices, they're getting rid of one of their strongest tools that they have on their tool belt in the event the economy pulls back. And so I don't think we're going to see that come up anytime soon unless we see some negative impacts from tariffs next few months. But that dynamic is always an interesting role when you only have two things that you're really looking at, and that's your job. And that's where the Fed is right now, and that's what we're looking at. All right, and let's go on to our next question.
How often should I be reviewing or rebalancing my portfolio in this kind of market?
So there's no question that from a rebalancing or review portfolio, this has been a pretty wild ride over the past year. We've seen big swings up, big swings down, then big swings back up again just over the past 6-7 months or so. And so it's natural to look at it and say, what should I do? Right? Rebalancing, a question we get a lot, so you're not alone on this one. There's a couple ways to think about it. One is a time-based rebalancing, which is typically what we follow of, let's set a time in the year, typically like an annual review, where we look at everything, rebalance, get it all aligned, and then let the portfolio roll for the next year and let it go up and down and seesaw around everything. And then at the end of the year, pull it all back together. That is completely fine from a research perspective. That works well. The other options are threshold based. This it's not as common, especially for do-it-yourself investors, because it requires you to look at all of your weights. And let's say you have a goal of 30% in large cap value stocks, and value does well. And you would set balance and say, if value goes above 35% of my portfolio or below 25% of my portfolio, then that's going to send a trigger for me to go in and rebalance my portfolio. So that's not necessarily a bad strategy. It just requires a little bit more reviewing of your assets, a little bit more activity on your part of making sure that you're following where the assets are. There's not a huge difference between those two. The only advantage that you can run into with the threshold rebalancing is if you see some big swings in the market, then maybe that allows you to do tax loss harvesting and rebalance the portfolio at different times so you have consistent risk throughout the year. But the normal volatility of the markets, rebalancing once a year, even a rocky year, the market is not likely moving enough in one direction or another to really say you have to go to the threshold. Rebalancing route, time-based rebalancing works very well. The other benefit of that is the time-based reality takes the emotion out of it. As much as we have market volatility with ups and downs, the concern that always comes up, and I hear this regularly, my clients talk to me, they say, it's like, well, the market was going crazy, so I just didn't open my account. I didn't want to look at what the portfolio was doing, which is completely normal. Why would you want to go open the account and see a bunch of red? So in a threshold-based rebalancing, though, that is exactly when you would have to be opening up your account, and not only open your account to look at it, but you would have to be opening the account and placing trades at that time, which most people don't want to deal with, and you start to run the risk behavioral issues. And those are really real concerns that you'd have to have, where if the market's down 20%, 30%, and you're forcing yourself to go in the account, maybe we just go into cash for a little bit until all this smooths out, and then we'll get back in the market. That's the exact risk, and we've seen that happen recently. Right? The market down 20% in April, and it's back up. Now we're at all-time highs. If you would have taken the money out at that drop, you would have missed out on the run-up afterwards, which is never a good sign. Remember, if you're timing a market, you have to be right twice. You have to be able to say the market's too high, so I want to sell and move to cash. And then you have to be right a second time when you say the market has finally reached the bottom, and now it's time for it to go back up. And it is much, much harder to get both of those right in a row. And because if you miss one of them, it doesn't matter anymore. So when we're talking about rebalancing, obviously the two options there, time-based, threshold-based, you want to be careful with behavioral issues. I'm a huge fan of trying to remove emotion as much as possible from any type of trading activity, where if you can go in and set a date on your calendar that says, I rebalance on this date, and that's it. Whether the market is up, down, sideways, or on fire, doesn't matter. You're rebalancing on that date, and it takes all the concern, emotion, and any type of gut reactions out of it. It's just the rules that you're following. And now we can jump into our rotating special segment. This week we have Tool Spotlight, where we highlighted a financial planning resource we think is worth you knowing about. So this one has come up a few times. I regularly get asked for any good apps or financial tracking software for generally net worth, sometimes spending. And there's a few that kind of come to mind. And some we've talked about before, whether it's meetings or podcasts, things like Mint is great for budgeting and day-to-day, how much did I spend on groceries versus how much did I spend on gas type of scenarios, but it's not great at investments. Right? Personal Capital, great for investments, right? Not as great for budgeting, but they are also active managers, so you get a lot of fun phone calls of them trying to constantly pitch you on these scenarios. Right? The last one is Kubera, right? And this one's relatively new. It's come up a couple times, and it's pretty interesting. Unfortunately, they don't have an app, but it is more of a net worth tracking tool. So it's not a budgeting tool. It's a little stronger in the investment side to calculate your ROIs. But what I like about it's very clean. It allows you to pull in other types of assets as opposed to just financial assets. So you can put in real estate in there, and it'll link it up to Zillow. You can put in cryptocurrencies in there, any alternative assets, and it'll create values there for you. So it's a much more living net worth statement. Now, it does come with a cost, but it is an interesting option to put in your kind of tool belt if that's something you're concerned with. And I know many of you out there have your Excel spreadsheet that you're very proud of to track net worth. And that's a good way to go, especially to stay kind of informed with your net worth statement. So this may be an add-on to it or make your life a little bit easier if you're trying to track net worth throughout the year. Hey, this is Stefan Scheid. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, share with us at scholarfinancialadvising.com/podcast. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.